In crypto, everyone's looking at the same market, but the way that they trade couldn't be more different. Two of the most common methods are spot trading and perpetual trading, also known as perps. And while they might look similar, they unlock very different ways to engage with the market. So let's break down the key differences and why the choice matters. Starting off with spot trading is the most direct way to buy and sell crypto. It means purchasing and holding the actual asset like Bitcoin or Ethereum at the current market price. This method is simple, it's super straightforward, and it's where most traders begin. But with this simplicity comes limitations. Spot trading is one-directional. It only benefits when prices rise, and there's no built-in way to take advantage of downward trends, and buying power is generally limited to the capital deposited by the trader. Perpetual contracts, or perps, are derivatives that let traders speculate on the price of an asset without owning it directly or needing as much capital upfront to open larger positions. They give traders the flexibility to go long when anticipating a price increase or open short positions to profit from a market drop, essentially allowing trades on both sides of the price movement. They also support margin trading, which means using collateral to open larger positions, offering traders much greater capital efficiency. For example, platforms like dYdX offer up to 50x buying power on deposited margin. So let's take a closer look and lay out how these two approaches differ and what traders might consider before choosing one over the other. The first difference is flexibility in how a market can be traded. Spot trading only benefits from upward price movement. Perps let traders go long or short, meaning both directions are in play. The second difference comes down to buying power. Spot trades are limited to the funds in the trader's wallet. With perps, traders can use margin as collateral to access larger positions, and this boosts both the opportunity and the risk. However, it's this greater capital efficiency that is a major reason active traders favor perps. Next is functionality. Perps often come with advanced features like stop losses, take profit orders, and the ability to automate trades and actions when certain price levels are reached, and this enables more of a precise approach to both controlling positions and managing risk in real time. While some spot platforms offer similar features, they're often more limited or less integrated. The final difference is just use case. Spot is typically just used for buying and holding an asset with minimal active management, and perps are just built for more strategic, hands-on trading, ideal for those who are looking to react to market shifts and adjust positions in real time. So why are more and more active traders choosing to trade perps over spot? Well, perps aren't just for speculation. They're about capital efficiency, they're about risk management, and they're about having more control in every single market condition. And for those already trading actively, platforms like dYdX take it a step further, offering incentives through programs like Surge. Surge distributes millions of dollars in monthly rewards to traders simply just for staying active and doing what they're already doing, which is trading. For a full breakdown on how Surge works, check out the explainer video, which is linked below. So while spot trading remains a strong entry point, for active traders looking for more ways to engage with the market, perpetual contracts offer far more flexibility and a much bigger toolbox to manage risk. And with platforms like dYdX offering hundreds of markets, advanced features, and powerful mobile and web platforms, getting started is easier than ever.